Beloved seekers of clarity, dear family of patient investors and thoughtful builders of wealth, there exists a question that has haunted investors for generations, a question that seems impossibly complex, a question that fills entire textbooks and spawns endless debates, a question that most people believe requires advanced mathematics, sophisticated models, and years of study to answer. THECMEC, IOSC, PLAI, and CGHT. How do you know what a stock is truly worth? How do you separate price from value? How do you look at a business and determine whether it's a bargain or a trap? How do you value a stock? And here's what I'm going to tell you today. Something that will either liberate you or frustrate you. Something so simple that you'll wonder why nobody taught you this from the beginning. Something that cuts through all the complexity and gets to the heart of what matters. The easiest way to value stocks, Dom, is not what they teach you in business school. It's not complex discounted cash flow models. It's not comparing dozens of financial ratios. It's not sophisticated algorithms or proprietary formulas. The easiest way to value stocks is something far simpler, far more intuitive, far more accessible to anyone willing to think clearly. But before I reveal this approach, before I share the framework that has guided my investing for over 7 decades, I need to tell you why most valuation methods fail most people, why complexity in valuation often leads to worse decisions than simplicity, why being approximately right is better than being precisely wrong. Let me take you back to a moment early in my investing journey. I was in my 30s, still learning, still believing that more sophisticated analysis meant better results. And I spent weeks building an elaborate valuation model for a company I was considering. I built a detailed discounted cash flow analysis. I projected revenues 10 years into the future. I estimated margins, growth rates, capital requirements. I calculated terminal values. I adjusted discount rates for risk. I ran sensitivity analysis with dozens of variables. My spreadsheet had hundreds of cells. My assumptions filled pages. My final output was a precise number. This stock was worth exactly $42.17 per share. I was proud of this analysis. It felt sophisticated, scientific, professional. And the stock was trading at $38. So according to my model, it was undervalued by 11%. I bought it. 5 years later, that stock was trading at $22. I'd lost nearly half my investment. And when I look back at my elaborate model, when I honestly assessed what had happened, I realized something humbling. My precise valuation had been precisely wrong. I'd spent weeks building a complex model that gave me false confidence. That made me believe I knew something I didn't actually know. That convinced me I could predict the future with mathematical certainty. But the future didn't cooperate with my spreadsheet. The business evolved in ways I hadn't anticipated. Competition intensified. Management made poor decisions. The industry changed. And all my precise calculations, they meant nothing. That experience taught me something profound. Something that changed how I approach valuation forever. Precision in valuation is an illusion. You cannot know exactly what a business is worth. You can only develop a reasonable range, a sense of whether something is clearly cheap, clearly expensive, or somewhere in between that requires deeper thought. And that realization, that acceptance that precision is impossible, it actually made me a better investor, because I stopped trying to calculate exact values and started asking simpler, more important questions. Questions that anyone can answer. Questions that don't require complex mathematics. Questions that get to the heart of what actually matters. So let me share with you the easiest way to value stocks, the approach that has served me well for decades, the framework that's simple enough to use anywhere, anytime, without spreadsheets or calculators. Simple enough that you could explain it to an intelligent teenager and they'd understand immediately. It's based on one fundamental question. One question that, if answered honestly and thoughtfully, tells you almost everything you need to know about whether a stock is worth buying. One question that cuts through all the noise and complexity. Are you ready for this question? Here it is. If you bought this entire business today, at the current market price, could you reasonably expect to earn a satisfactory return over your ownership period? That's it. That's the question. Simple, direct, intuitive. And embedded in that simple question are all the elements of sound valuation. Let me unpack it for you. Let me show you why this question, properly understood and answered, is more powerful than any complex model, First, notice the frame. If you bought this entire business, not shares, not a ticker symbol, not a trading vehicle, a business, this mental shift is critical. Because when you think about buying a business, your whole psychology changes. You start asking owner questions rather than trader questions. Would I want to own this business? Do I understand what it does? Is it a good business? Does it make money? Will it still be relevant in 10 years? These are the questions owners ask. And these are the questions that lead to good investment decisions. But when you think about buying shares, you start asking different questions. Is the stock going up? What's the momentum? What are analysts saying? These are trader questions, and they lead to speculation rather than investment. So the first step in easy valuation is reframing. You're not buying stock. You're buying a piece of a business, and you need to evaluate it the way you'd evaluate buying any business. Second element, the current market price. This forces you to think about what you're actually paying, not what the business might be worth in some theoretical sense, but what you're paying today at this price. This is where most valuation errors occur. People fall in love with a business. They think it's wonderful, and they convince themselves that any price is acceptable because it's such a great company. But great companies can be terrible investments if you pay too much. The best business in the world becomes a bad investment at the wrong price. So you must always anchor to the actual price being asked. Is what I'm paying reasonable for what I'm getting? Not is this a good business, but is this a good business at this price? Let me tell you about a mistake I made by forgetting this principle. There was a technology company, dominant market position, excellent management, growing rapidly. Everything you'd want in a business. I loved the company, studied it extensively, understood its competitive advantages, believed in its future. And I bought shares. At 35 times earnings, I convinced myself that quality justified the premium price, that this business was so exceptional that valuation didn't matter as much. I was buying a piece of excellence. But 35 times earnings meant I was paying 35 years' worth of current profits for the business, which meant I needed either profits to grow substantially or I needed other investors to be willing to pay even more expensive multiples in the future, or I needed to hold for decades to justify the price through actual business earnings. And you know what happened? The business did fine, grew nicely, profits increased, management executed well, but the stock went nowhere for 7 years. Because I'd paid such a high multiple that even good business performance couldn't justify further price appreciation. Other investors weren't willing to pay 35 times earnings anymore. The multiple compressed to 20 times. And even though earnings grew 40% over 7 years, the stock price barely moved. I hadn't bought a bad business. I'd bought a good business at a bad price. And price matters. Always, even for wonderful companies. Maybe especially for wonderful companies, because that's when investors are most likely to overpay out of enthusiasm. So the second element of easy valuation is price consciousness. Never fall so in love with a business that you forget to check the price tag. Third element, could you reasonably expect to earn? Notice the language. Not will you earn or should you earn or might you earn, but could you reasonably expect? This acknowledges uncertainty. The future is unknowable. You cannot guarantee returns. You can only assess reasonable expectations based on available information. This is liberating. You don't need to predict the future precisely. You don't need to know exactly what earnings will be in year 5 or year 10. You just need to form reasonable expectations. Ballpark estimates. Informed guesses based on understanding the business. Can this business reasonably be expected to generate enough profit over time to justify what I'm paying? That's all you're trying to determine. Not perfect projections, just reasonable expectations. Fourth element, a satisfactory return. What's satisfactory? That depends on you, on your goals, on your alternatives, on what else you could do with the money. But you need a benchmark, a hurdle rate, a standard for what makes an investment worth making. For me, the hurdle has always been simple. Can I reasonably expect this investment to outperform a simple index fund over the long term? Because if I can't, if the risk-adjusted expected return isn't clearly better than just owning the market, why bother with the complexity of individual stock selection? Some investors use 10% annually as their hurdle. Some use 12 or 15%. The specific number matters less than having a number, a standard, a way to say yes or no to an investment opportunity. Fifth element, over your ownership period. This implies you have an ownership period in mind, that you're not buying to sell next week or next month, that you're thinking long term, that you're willing to own this business for years. This long-term orientation changes everything about valuation, because if you're thinking years or decades, short-term noise doesn't matter. Quarterly earnings misses don't matter. What matters is the fundamental trajectory of the business over long periods. Can it compound value for years? That's what you're trying to assess. So there's the framework. The easiest way to value stocks. One question with 5 elements embedded in it. If I bought this business today at the current price, could I reasonably expect to earn a satisfactory return over my ownership period? Answer that question honestly, and you have your valuation. You don't need a spreadsheet. Don't need complex mathematics. Don't need to pretend you can predict the future precisely. You just need clear thinking about what you're buying, what you're paying, and what you can reasonably expect. But now comes the hard part. How do you actually answer that question? How do you form reasonable expectations about future returns? How do you assess whether a price is fair without complex calculations? Let me give you a simple mental model. A back of the envelope approach that anyone can use anywhere. It's based on something called the earnings yield. And it's so simple you'll wonder why anyone uses anything more complex. The earnings yield is just the inverse of the price to earnings ratio. If a stock trades at a PEE of 20, the earnings yield is 5%, because 1 divided by 20 is 5%. That's it. That's the calculation. No PhD required. And here's why this matters. The earnings yield tells you roughly what return you'd get if you owned the entire business and it paid out all its profits to you. If a business earns 5% on your purchase price, that's your baseline return if nothing changes. Now, obviously things change. Businesses grow or shrink. Margins expand or contract. But the earnings yield gives you a starting point, a rough sense of what you're getting for your money, and you can compare it instantly to alternatives. If a stock has an earnings yield of 5% and you can get 4% risk-free in treasury bonds, you're only getting 1% premium for taking equity risk. Is that enough? Probably not. Not for most investors. Not for the additional risk and volatility of stocks. But if a stock has an earnings yield of 10% and treasuries are at 4%, now you're getting 6% premium. That's starting to look interesting. That's compensation for risk that might be adequate, depending on the quality of the business and your confidence in its future. This is easy valuation in action. You're not building complex models. You're comparing yields. Earnings yield versus bond yields. Earnings yield versus what you need to hit your goals. Earnings yield versus other stocks you're considering. Simple, intuitive, quick, and surprisingly effective at separating clearly cheap stocks from clearly expensive ones. Let me give you an example from real life. Back in 2008, during the financial crisis, there was a major bank trading at 4 times earnings. 4 times, which meant an earnings yield of 25%. 25% if that bank survived. If it just earned the same profits it was currently earning, you'd get a 25% annual return on your purchase price through earnings alone. Now, obviously there was risk. The bank might fail. Earnings might collapse. That's why it was so cheap. But if you believed the bank would survive, if you believed it would continue earning reasonable profits, the price was absurdly low. The earnings yield was so high that even substantial business deterioration would still leave you with decent returns. That's when easy valuation becomes powerful, when you can look at an earnings yield and immediately know this is cheap, not by building elaborate models, not by pretending to predict the future, just by recognizing that at this price, even if things go moderately wrong, you'll probably do okay. And if things go right, you'll do spectacularly. The bank survived. Earnings recovered. The stock multiplied many times over. And the signal was right there in the earnings yield. Simple, obvious, available to anyone willing to do basic arithmetic. THEDEPAR Now let me show you how to make this easy valuation framework even more powerful. Because while the earnings yield gives you a starting point, understanding a few additional factors can sharpen your judgment dramatically. And these factors, like everything I'm teaching you, are simple. No complexity required, just clear thinking about fundamentals. The first additional factor is growth, because the earnings yield calculation assumes nothing changes. But businesses do change. Some grow, some shrink, and growth dramatically affects what you should pay. Let me show you why this matters. Two companies, both earn $1 per share. Both trade at $10 per share. Same price, same earnings yield of 10%. Are they equally attractive? Not necessarily. Not if one is growing and one isn't. Company A's earnings have been flat for 5 years, no growth. Mature industry. Limited expansion opportunities. That 10% earnings yield, that's probably all you're getting. Your return comes purely from the earnings yield plus whatever dividends they pay. Static business. Static returns. Company B's earnings have been growing 15% annually for 5 years. Growing market. Competitive advantages expanding. Strong reinvestment opportunities. That 10% earnings yield. That's just your starting point. As earnings grow, your yield on original cost grows too. In 5 years, if earnings keep growing, your yield on your original purchase price might be 20%. In 10 years, maybe 40%. Same starting earnings yield. Vastly different outcomes, because growth compounds. The growing business becomes more valuable over time. The static business stays roughly where it started. So when you're doing easy valuation, when you're assessing that earnings yield, you must ask, is this business growing, shrinking, staying flat, and adjust your expectations accordingly. But here's the key. You don't need to project exact growth rates for 10 years. You don't need precision. You just need a rough sense. Is this business likely to grow meaningfully over the next 5 to 10 years? Or is it mature and stable? Or is it declining? 3 categories. Growing, stable, declining. That's enough. You can put almost any business into one of these buckets with modest research. And knowing which bucket changes everything about what you should pay. For growing businesses, you can accept lower starting earnings yields. Maybe 7 or 8%. Because growth will increase your effective yield over time. For stable businesses, you want higher starting yields, maybe 10 or 12%, because that's all you're getting. For declining businesses, you need even higher yields, maybe 15% or more, because earnings are going to shrink, reducing your effective yield over time. See how simple this is? No complex growth projections, no detailed modeling, just asking growth stable or decline, and adjusting your required earnings yield accordingly. Let me tell you about an investment I made using exactly this approach. There was a consumer products company. Boring business, so toothpaste. Basic household goods. Nothing exciting. Trading at 12 times earnings. Earnings yield about 8%. Now, 8% earnings yield isn't spectacular. Treasury bonds were yielding close to 5% at the time, so I was only getting 3% premium for equity risk. Barely adequate. But then I asked, is this business growing? And the answer was yes, slowly, maybe 5 to 7% annually. Growing population, expanding into emerging markets, stable market share in developed markets. Nothing dramatic, but consistent, reliable growth. That changed the equation. An 8% starting earnings yield, growing at 6% annually, means in 10 years my yield on original cost would be about 14%. In 20 years, about 25%. The growing earnings turned an adequate starting yield into an excellent long-term investment. I bought shares, held for 15 years, and my total return was about 12% annually, not from the stock price increasing dramatically, but from the business compounding, growing earnings, increasing dividends, the yield on my original purchase price expanding year after year. That's the power of understanding growth. Even modest growth sustained over time transforms adequate investments into excellent ones, and you don't need complex projections to recognize which businesses are likely to grow. The second additional factor is quality, because not all earnings are created equal. Not all businesses with the same earnings yield are equally attractive. Quality matters. Durability matters. The sustainability of those earnings matters enormously. Let me explain through contrast. 2 businesses. Both earn $5 per share. Both trade at $50 per share. Both have 10% earnings yields. Same numbers, but very different qualities. Business A operates in a highly competitive industry with no barriers to entry. Its profits fluctuate wildly based on commodity prices. It requires constant capital investment just to maintain position. Management has a history of poor capital allocation. The business has no pricing power and competes primarily on cost. Business B has a dominant brand that consumers love. It operates in a stable industry with high barriers to entry. It generates more cash than it needs to reinvest. Management has consistently created shareholder value. It has pricing power and can raise prices without losing customers. Same earnings yield, but would you pay the same price for both businesses? Of course not. Business B is clearly more valuable because those earnings are more durable, more reliable, more likely to persist and grow over time. So easy valuation requires assessing quality. And quality, like growth, doesn't require complex analysis. It requires asking simple questions. Does this business have competitive advantages that protect its profits? Are these advantages durable or temporary? Does the business require massive capital investment just to stay competitive? Can it raise prices without losing customers? Is management competent and shareholder friendly? Will this business likely exist and be profitable in 10 years? These questions, any thoughtful person can answer them with basic research, reading annual reports, understanding the business model, thinking about the competitive dynamics. You don't need insider information or advanced financial training, just clear thinking about fundamentals. And the answers dramatically affect what you should pay. For high-quality businesses with durable advantages, you can accept lower earnings yields, maybe 7 or 8%, because those earnings are secure. They'll likely persist and grow. The business compounds value reliably. For low-quality businesses with uncertain futures, you need much higher earnings yields, maybe 12 or 15% or more, because there's significant risk those earnings won't persist. That competition will erode them, that the business model will become obsolete. Quality and price must match. Paying premium prices fine if the quality justifies it. Paying cheap prices is necessary if the quality is questionable. I learned this lesson through painful experience. Early in my career, I fell into what I call the cheap trap. I'd find businesses trading at very low multiples, 6 or 7 times earnings, huge earnings yields of 15 or 18%, and I'd buy them thinking I was getting bargains. Sometimes they were bargains. The businesses were temporarily out of favor, but fundamentally sound, and those investments worked out wonderfully. But often they were cheap for good reasons. The businesses were declining, losing competitive position, facing structural headwinds, and those high earnings yields were illusory because the earnings themselves were disappearing. I bought a retailer once at 6 times earnings yield of nearly 17%. Looked incredibly cheap, but the business was being disrupted by online commerce, foot traffic declining, margins compressing, management struggling to adapt. Within 5 years, earnings had fallen by half. The stock fell even more. My cheap purchase at 6 times earnings became expensive at 12 times declining earnings. I'd focused on price without adequately assessing quality. I'd been seduced by a high earnings yield without asking whether those earnings were sustainable. Classic mistake. Expensive mistake, but a teaching mistake. From then on, I changed my approach. I stopped buying businesses just because they were cheap. Started focusing on quality first, price second. Would rather pay a fair price for a wonderful business than a wonderful price for a fair business. Because wonderful businesses compound. Fair businesses deteriorate. And over long holding periods, quality matters more than purchase price. This doesn't mean you ignore price. It means you integrate quality and price together. You pay fair prices for quality. You require cheap prices for questionable quality. You avoid expensive prices regardless of quality. It's a balance, a judgment call, but a simple one if you're thinking clearly about both factors. The third additional factor is financial strength, because a business's ability to survive and thrive through difficult times dramatically affects its value. And financial strength, like quality, is something anyone can assess with basic research. Financial strength comes down to a few simple questions. Does the business have more cash than debt, or is it heavily leveraged? Can it easily service its debt obligations? Does it generate enough cash flow to fund operations and growth without constantly needing to raise capital? Could it survive a severe recession or industry downturn? These questions tell you about margin of safety, about resilience, about whether this business will likely be around in 10 years. And that matters enormously when you're valuing it. Let me give you a framework. 3 categories again. Strong balance sheet. Adequate balance sheet, weak balance sheet. Most businesses fall clearly into one of these categories with modest analysis. Strong balance sheet means little or no debt, substantial cash, consistent cash generation, no liquidity concerns. These businesses can weather any storm. They have flexibility to invest opportunistically during downturns. They're not at risk of bankruptcy even in severe scenarios. Adequate balance sheet means moderate debt that's easily serviceable, reasonable cash reserves, ability to fund operations through normal business cycles. These businesses are fine in normal times but might face stress in severe downturns. They're stable but not fortress-like. Weak balance sheet means heavy debt, limited cash, inconsistent cash generation, potential liquidity issues if conditions worsen. These businesses are vulnerable, might not survive severe downturns, require constant refinancing and capital raising, and just like with quality, the category determines what you should pay. For strong balance sheets, you can accept slightly lower earnings yields, maybe 9 or 10%, because there's minimal risk of the business failing. Those earnings are secure. The business can compound for decades. For adequate balance sheets, you want higher yields, maybe 11 or 12%, because there's some risk in severe scenarios. You need compensation for that risk. For weak balance sheets, you need very high yields, 15% or more, because there's real risk of bankruptcy or significant dilution if things go wrong. You're effectively taking distressed debt, like risk in equity form. You need massive upside to justify that risk. I once looked at 2 telecommunications companies, both in the same industry, both with similar earnings and growth prospects. One had virtually no debt and billions in cash. The other had 10 times its earnings and debt and barely enough cash to operate. They traded at similar prices, similar earnings multiples, similar earnings yields, but were they equally valuable? Absolutely not. The debt-free company could survive any downturn, invest opportunistically, return cash to shareholders. The heavily indebted company was one recession or one competitive challenge away from potential bankruptcy. I bought the debt-free company and avoided the leveraged one. Over the next 10 years, the industry faced significant challenges. New competition, pricing pressure, declining revenues. The debt-free company weathered it fine. Stock dropped during the challenges but survived and eventually recovered. The leveraged company went bankrupt. Equity holders were wiped out. Same industry, similar starting valuations, but financial strength made all the difference. And assessing financial strength doesn't require complex analysis. Just reading the balance sheet, understanding the debt obligations, thinking clearly about whether the business can handle stress. So now you have the complete easy valuation framework. Start with the earnings yield. Adjust for growth. Is the business growing, stable, or declining? Assess quality. Are the earnings durable and sustainable? Evaluate financial strength. Can the business survive difficult times? These 4 factors, earnings, yield, growth, quality, financial strength, they give you everything you need to form a reasonable judgment about whether a stock is cheap, expensive, or fairly valued. No complex models needed, no pretense of precision. Just clear thinking about fundamentals. And here's the beautiful part. This approach doesn't take weeks of analysis. You can evaluate most businesses in a few hours. Read the annual report. Understand the business model. Look at the balance sheet. Think about competitive position. Calculate the earnings yield. Form a judgment. Fast, simple, accessible, and if done with intellectual honesty and clear thinking, remarkably effective at avoiding terrible investments and identifying good ones.